Hi, and welcome to the part three and the concluding part of the presentation in the topic area of quantitative methods, the reading being that of rate and returns. Now, this particular portion is really an optional uh, one because in this I'm going to solve a few problems from the Institute's direct curriculum. And the idea is that it's not only supposed to give you an additional opportunity to cement your concept, but also would consolidate the whole learning that we have had so far. And also, it's an supplemental effort which I'm going to take going forward as well. Each of the chapters, the end of the chapters questions that's there, I'm going to pick up the top 40 to 50% of the questions and solve them along as we move along. Because I do firmly believe that at times, even despite the best of the efforts from the institute's end, the explanation to the answers may not always make logical sense. So as we build up those uh, concepts gradually, as we build up those uh, answers, and I'm going to walk you through the process itself, that will perhaps make much more sense. And it is with this expectation that going forward as well, each and every chapter that we are going to cover, I'm going to supplement it, top it up with the concept awareness part. But for the ones who feel confident, you may skip this portion at your will. All right, so without much ado, let's just dive in. And the first question that says that which of the following risk premiums is most relevant in explaining the difference in yields between a 30-year bond issued by US Treasury and a 30-year bond issued by small private corporate issuer? So of course, you can understand that in terms of timeline, both of them are same. One is a government bond, a GSEC, another is a corporate bond. Of course, you can understand that the corporate bond is going to offer higher yield or in layman's term, higher a return as compared to the government bond for one simple reason that it's more risky. So in order for investors to actually partake in this issue, they will have to be compensated with a higher rate of return or higher yield, as you would want to know. So all other things remaining constant, we have already understood that there are three major components that differentiates one fixed income security from the other, and those three actually revolve around the first and foremost is the default risk or the default risk premium, to be precise. Second is the liquidity risk. Third is, of course, the maturity risk as well. And of course, there is a component of inflation as well. But this inflation component, more or less, is uniform for all of the issues, regardless of where it is actually being issued from, who is the issuer. So the primary dominant premium risk premium factor happens with that of the default risk premium, as you would know. And for government, of course, we deem them default risk free. So, of course, the default risk premium does not quite figure out as far as the government bonds are concerned. Not so much when it comes to corporate bond. And this is also precisely the reason that why the government securities are going to be much more liquid than that of the corresponding private issue uh, being floated in the market. So we can pick up the options that are being given. Inflation, as I said, that inflation is going to be common for each one of them. Maturity is already common as has been given. So the only other option that remains is the liquidity. The corporate issue will command more liquidity risk premium for one simple reason that it will be thinly floated as compared to the government securities, and more volume will be in the government securities trading as compared to the corporate issue. So in order to compensate for the same, the corporate issuer will have to build in the liquidity risk premium. The second question says the portfolio manager invest a euro 5,000 annually in a security for 4 years at the following prices. So the price has already been given, and we are being asked to calculate the average price. And as before, you could use either of the two options. So one is that you could use the harmonic mean formula directly, which I would encourage once you have learn the concepts. So in this case, it's going to be four because there are four instances of four frequencies divided by uh, 1 by 62 by 1 by 76 plus 1 by 84 plus 1 upon 90. So this way you could solve the problem, or if you do not recall the harmonic mean formula or you wanted to completely abandon the formula, then you could go the usual route of uh, building the average price as equal to the total investment by being made over the 4 years period and divided by the um, number of shares. So number of shares by default is here going to be 4 because it's talking about one share per the share price is being given for on a per unit basis. So if you do this, I believe that the answer happens to be option number A, 76.48. The next question is all about the time weighted rate of return, the different return measures. So I read out a fund receives investment at the beginning of each year and generates returns for the 3 years as follows. So we have got this return measures T is equal to 0, T is equal to 1, T is equal to 2, and then finally T is equal to 3. And at the beginning of each year, assets under management that is being stated. So you could understand that there is the first initial investment is being as 1,000. So that, and the asset under management, this is the investment. And the asset under management at this point in time is also 1,000. At the end of the first year, the assets under management has been stated to be 4,000. All right. And here you may understand that a couple of things have happened. There is a return component which has been generated because of this initial investment, and that's already been stated to be 15%. So that means 150 has been generated as part of return. And the fresh investment that's being now made can be deduced from here. How do we arrive at the fresh investment? Well, that should be pretty simple. The AUM is equal to the ending AUM at T minus 1 year, that is the previous year, or at the beginning of the Tth year, plus return, if any, minus cash dividend. I'm making use of the word of cash dividend. It could be coupon as well, cash dividend as well, but I'm using the word dividend interchangeably, plus fresh investment is going to be the AUM at end of Tth year. I think that this must be logical to all of you. The beginning asset under management at the beginning of the year, plus the return that the asset under management has generated because of the previous investment being made. I'm sorry. Yeah, so the previous investment being made. If there be any cash outflow, so those cash outflow will have to be suitably deducted, and then if any fresh investment has been infused in the fund, they have to be suitably added. And then if we consolidate the whole thing, we're going to get the asset under management at the end of the Tth year. So that is what it is being said. I hope that this portion is clear to you. So you can understand that 150 is the 15% return that we are talking about that was generated because of 1,000 investment. The ending 4,000 has been given. So you can understand that the fresh investment that has been made is equal to 4,000. I'm just making it up. I'm just doing it for the first one. 1,000 was the initial investment being made. So it's 150. So if you do this, you get getting a value of, writing this as F dot I, that is fresh investment, as 2850. All right. So you could proceed this in this manner. For the year number 2, at the end of the year number 2, of course, this becomes the beginning investment, beginning AUM. And then again, there is a return component that is being generated that is 15%. And the AUM that's there is at the end of the year is 45,000 out here. So we can easily figure out that what's going to be the fresh investment out here. And as before, the fresh investment is going to be 45,000 minus 4,000 minus 14% generated on 4,000. Uh, we could do this, which is 560. All right. So the fresh investment, uh, you could think of the fresh investment as 45,000 minus 4,000 minus 560 or 40,500. 40,440. I'm sorry, 40,440. And then this is at the end of the second year. And the third year, of course, as it says, that there are certain returns being generated. However, the AUM at the end of the third year is not being mentioned. So here we will have to assume that the fund is completely liquidated at the end of the third year. So at the end of the third year, the asset under management by default has to be zero. And it suits our calculation purposes as well, because without that, we'll not be able to work through the means, different means that are being said. Okay. So I leave it to you. What does that, how to calculate that? But as far as the returns were concerned, returns were obviously, you could understand, is 1800 negative return has happened. 1800 negative return has happened. All right. And the rest of the 43,200. So this 43,200 will also be liquidated. Okay. So this is what our entire cash flow scenario, this is how it actually looks like. But that is not the question that is being asked. For me to take you through this entire exercise is for you to understand that how this problem has actually been built up in the first place. The question is asked that which return measure over the 3-year period is negative. Now, truth be told, neither for question number 6 and the following question, that is question number 7, you actually do not require any calculation to be performed. The reason being that the institute also does not want you to go through the calculation because it could be lengthy. As I'm explaining through it, you could understand that it could be lengthy. But this is more of a conceptual question, and if you've learned about the different return measures correctly, you would know that the money weighted rate of return is always more volatile as compared to the rest of the return measures, right? Now, as far as the geometric return measures are concerned, it is pretty easy, pretty simple. What we all need to do is to take the cube root of 1.15 multiplied by 1.14 multiplied by 0.96 minus 1. You would obviously know that this return measure cannot be negative. Okay, this return measure cannot be negative. This is pretty well understood from here. So this is definitely not the option. Between the two return measures, that is the time weighted rate of return and the money weighted rate of return, we know that the money weighted rate of return is more volatile. Why is it so? Because it has got a couple of determining components. One is the magnitude of the infusion, the investment that is being made, or should I say the disinvestment that is being made. That's important. And second is obviously the timing of the infusion. That both of them are important. Also, we must understand that because these two heavily will influence the outcome, and since we have already stated that the third year's return measure is a negative 4%, so obviously before a downturn return, if large amount of sum has been infused in the fund, that's only going to amplify the whole result. So in this case, obviously, the money weighted rate of return is going to generate a negative return, and it is going to be much lesser than that of the corresponding time weighted rate of return. And just to tell you that this is what it is, I would implore all of you to go through this particular slide wherein I have discussed the key differential points, the difference points between the money weighted rate of return and that of the TWRR. You could pause again this portion of the slide and go through it. What does it says? It has been clearly mentioned that MWRR will yield volatile returns as and wherein the TWRR is going to return, it's going to have a more stable return. All right. Now, rather than me being caught up in the calculation myriad, what I'm going to do is to take you through a simple spreadsheet, and where I have actually partially worked out the problem. And I'm sure that once you go through the spreadsheet, it should be amply clear to you as well. All right. So I hope that the screen is visible to all of you. All right. Okay. So this is my MWRR calculation. All right. So as stated, the beginning of the year value is for the 0th year. Obviously, there is no beginning of the year value. There is only a ending balance of 1,000, which of course becomes the beginning of the year value for year number one. The year generated 15% return. There was no cash redemption across the um, 3-year period. Of course, there has been total redemption at the end of the 3-year period. That's understood. So that is to say that there is no interim cash outflow that has happened in terms of any sort of dividend. And the absolute return is simply the percentage multiplied by the beginning of the year value, or the AUM. So you could see that it is 150 positive, 560 positive, and 1800 negative. Exactly the same figures that we had discussed in our presentation. So that would help us in finding out the fresh investment being made, because the fresh investment is a plug figure, which revolves around the ending balance minus the beginning of the year value minus the return that is being generated in absolute term. So you could figure out this as well. I'm hovering. Please follow the syntax where I put in my cursor. So this should be amply clear to all of you. Now the cash flow out here, the fresh investment out here is now what is being deemed as the net cash flow. I think that should again be clear to all of you. Initially, you made an investment of 1,000. Thereafter, the net investment that was being made after the return measure, of course, is 2,850, 40,440, and obviously last is all about redemption. The money weighted rate of return is simply the internal rate of return, and all I did was put in the internal rate of return formula. And I hope that you could do it in your spreadsheet, as well as you could do it in your calculator as well. I have already stated this multiple times, so I don't think I need to talk about this. And if you do this, you're going to get a value of 2.22%, rounded up to 2.2% only, which is negative. So this measure is, of course, the negative measure. And at the same time, we also must understand that if you want, we could calculate the holding period return as well for each of them in order to calculate the TWRR. And I leave it to you for you to do it as an exercise. And that is definitely not going to be negative. All right. So I hope that this is understood, vetted, with the only understanding, with the only suggestion being made is that the last 10-15 minutes of me actually going through this problem is not required as far as your exam is concerned. That's going to be completely redundant if you know the underlying concept here. Okay. So in a downturn, the money weighted rate of return is always going to return a negative value. The money weighted rate of return is more volatile as compared to its corresponding time weighted rate of return. All right. So Extending the same concept, I read out the next problem. At the beginning of the year one, so we have 0, we have 1, possibly second year as well. A fund has a 10 million under management. So the beginning value has USD 10 million under management. So this is your beginning AUM, asset under management, and it earns a return of 14%. So 14% return, it earns, you could figure out the absolute return as well. That's going to be 140 of, that's going to be 1.4 million. I'm sorry. That's going to be 1.4 million in absolute terms, 14% of the year. The fund attracts another USD 100 million at the start of the year two. So fresh investment is being already stated to be USD 100 million. That is obviously at the end of the year, and that it will bring us the ending AUM as well. And I'm sure that you can calculate the ending AUM, which is going to be 114. I'm sorry, this is going to be 111.4 million. All that we did is simply added the beginning of the year asset under management, the absolute return, and the fresh investment being made. Simply added out. Obviously, there is no cash redemption because the fund does not pay any dividend, interim dividend. So there is no need for adjusting for that. And of course, this 114 million now becomes the next year's beginning AUM. 114 becomes the next year's AUM. And this year it earns around 8%. So the absolute return measured out here is 9.2 million during the year two. All right. The money weighted rate of return in the fund is most likely to be less than the time weighted rate of return, same as the time weighted rate of return, greater than the time weighted rate of return. Again, this does not quite require any calculation. Why is it so? Because of one simple reason, that you need to understand the relationship between the MWRR and the TWRR. In this case, what happens that the firm on a relative basis, not on an absolute basis, on a relative basis has underperformed. Mind you, it did not lose, but as compared to the initial year, first year, the second year return has been an underperformance. So of course, when it's underperformance, the money weighted rate of return is going to be more volatile, more so because there has been a fresh investment being made just before the underperformance year. So remember, whenever this happens, that a fresh investment is being made before a downturn performance, the money weighted rate of return is going to yield lesser rate of return as compared to the corresponding time weighted rate of return. And if it were the other way around, which would imply that there is an upturn, there is a positive outperformance for a given fund in a year. So the year preceding that, at the beginning of the year itself, if a fresh investment is being made at that particular point in time, the money weighted rate of return is simply going to amplify that return measure as well, which means that they are going to be more than the or greater than the time weighted rate of return. This happens because the money weighted rate of return is more volatile as compared to the time weighted rate of return, which it does not depend on the magnitude of the investments and more precisely fresh investment being made. All right. So again, there is no need for you to do any calculation. You would only, if you would know this, then you would know that because of this underperformance out here, the money weighted rate of return is going to be more volatile. So it is going to be obviously less than that of the time weighted rate of return. Just to ensure that we have done this thing correctly, I'm going to again take you through a peekaboo in the spreadsheet as well, just to prove the point. And this is how it looks like in the same spreadsheet. All right. So the beginning of the year AUM was 10 million, and it generated 14% return. Absolute return became 1.4, as we are discussing. Ending balance was 111.4, which became the beginning of the year two AUM, which generated a return of 8%, corresponding to absolute return of 8.912%. There was no fresh investment being made, so we will have to assume, or it is deemed, that the fund is liquidated at the end of the period two. So all that we need to do to understand the MWRR is to take these cash flows. The cash flows are there in front of you, and calculate the IRR, and it happens to be 8.53%. And in order to calculate the TWRR, we'll have to first find out the holding period return, and you would know the holding period return, how to calculate that. I'm not going to explain this over and over again. So it's simply, in this case, since there has been no cash redemption, so we can simply take the ending balance and divide it by the beginning balance to arrive at the 1 plus HPR for that period. So we could calculate the 1 plus HPR period for the period 1, and we could do the same for period 2, multiply the same, and then take the square root of the same and deduct 1 from that. And if you do that, you're going to end up with a value of 10.95%, almost close to 11%. So of course, you could see that the TWRR return is around 11%, while the MWRR is at around 8.5%. And this happened because of the underperformance. All right. So do remember that it's not always that CFA Institute is going to test you in the actual exam with calculation intensive questions. Also, although it could be deceptively similar to that, many of the times is only going to hover around your understanding of the whole concept, and just that about it. All right. So the stock price, the next question reads that the stock price is at time t is equal to 0 and time t is equal to 1 has been given. The continuously compounding rate for the stock is closest to. So again, this is pretty easy. All that you need to do is to take the return measures, that is 186.75 divided by 208.25, and simply take a log of the whole thing. And then there you will have the continuously compounded return measure. All right. 186.75 divided by 208.25. So we are getting, and we'll have to deduct obviously 1 from here. And if you do that, you're going to get a negative of 10.32%. Now, if you're flummoxed about how I directly use the log formula, so do remember the formula of FV is equal to PV into e to the power RT. In case of continuous compounding, we have to find out the R. So you could do the same thing out here. I just skipped those steps because, as I said, that your calculator provides those elegant shortcuts, and you must make those use of those elegant shortcuts profusely. And all I need to do is to take the R. All that we need to do is to take the log of this. So log of e to the power RTT is obviously 1 out here, FV by PV. Now you know that since we have taken the log out here, R is going to come out from this, RT is going to come out from this, so, but T is equal to 1. So it's basically R into 1. Log of E to the base E is always going to be 1. So R, in this case, and simply from there, we deduct the 1 to arrive at the 10.32% negative. So I just skipped these many steps and made use of the calculator. That's all. The next question reads, a USD 25 million equity portfolio is financed with 20% debt at a cost of 6% annual, and equity portfolio generates a 10% total return. The leverage return has been asked. So as before, since I've already worked through the common sense, the leveraged return, I'm going to directly use the formula. To understand a thing that whenever I'm using a direct formula out here, I'm not recalling that from my memory. I know the underlying science, I know the underlying concepts, and that's how I'm using now the shortcut to arrive at my answer, because under the exam conditions, it's only 90 seconds that I have on an average for every question that I attempt. So if I know the shortcuts, I'm going to use them profusely, knowing that in the unlikeliest of circumstances, should I do forget the formula, I could easily recall that and work my way through. So out here, the value of debt divided by the value of equity, and then the cost of debt has to be proportionally deducted from the return. So now simply substitute the value, 10% of the total return, and the value of debt is around 20%. So do understand that the absolute value of 25 million does not quite figure out here. So it is going to be 0.2 divided by 0.8. And this is going to be 10% minus the cost of debt as 6%. So if you work this out, let me also do it at my end. So it's going to be around 11%. All right. The next question says that at the beginning of the year, investor holds euro 10,000 in a hedge fund. The investor borrowed 25% of the purchase price, that is around 2,500, at an annual interest of 6%, and expects to pay 30% tax on the return she earns from his investment, from his investment. At the end of the year, the hedge fund reported the information as gross returns, trading expenses, and managerial and administrative expenses. The investor's after-tax return on the hedge fund investment has been asked. This should be absolutely easy for all of you, because the answer to this is 5%, and I don't think I need to work through this also. There is only one catch to this whole thing, and that you need to understand that this 1.10% is already embedded into the gross return. So do not make the mistake of actually deducting this from 8.46% to arrive at the net return to the investors. Okay, so you'd be tempted to do that. Don't do that. The gross return already embeds the trading expenses. So when we are talking about the pre-tax return, and uh, so first and foremost, that this is also a leveraged portfolio. So in this leveraged portfolio, the pre-tax leveraged return will have to be calculated. So the pre-tax, as you would know, that this is going to be the absolute return that is being generated, that is 8.46%. That's being stated, plus again, as you see that the absolute values do not figure out anywhere, and that's understandable. So first and foremost, we'll have to understand this pre-tax return. I'm sorry, this is okay. So this has to be adjusted. There is a slight bit of a problem that I made. So this has to be adjusted with the managerial expenses. Of course, the trading expenses is part of the gross return, but the managerial and administrative expenses is not. So that has to be suitably adjusted first. So we'll have to deduct the 1.6% from this 8.46% of gross return. So this actually then defaults to 6.86% plus 0.25 divided by 0.75. Then we have 6.86% minus 6% out here. Okay. So, all right. So this becomes 7.14%. And since we have been asked about the after-tax return, so the after-tax return is going to be the pre-tax return into 1 minus tax rate. And the tax rate happens to be 30%, as has been mentioned. So simply speaking, we have to take 70% of 7.14%, 7.14% into 1 minus 30%, because 30% is the tax rate. And if you do this, this value is going to come out to 5. And that's your answer. So I hope that through this extensive, although optional, portion of the lecture, you have been able to thoroughly understand the first chapter in the quantitative methods, that's about rates and return. This chapter is an important chapter by all means, because as I said multiple times, that it's just not about understanding this particular chapter in isolation, but this is well integrated into the other topics areas as well. Stay tuned for the next presentation. Thank you.